And welcome to the Sherman Show. I'm Jeff Sherman, here today with my co-host, Sam Lau.
Hey, hey.
And today we are recording on Thursday, August 11th, 2022. And today we have a very special guest coming to us. His name is Todd Rosenbluth. He is the head of research at VettaFi. In his role at VettaFi, Todd is responsible for overseeing the firm's research into ETFs, product trends, and advisor behavior. Todd, welcome to the show.
Thanks. Great to be with you, Sam and Jeff.
Yeah, and as Sam always says, you know, I have the face for radio and face for podcasting, but if you want to see this one live in close in person, you can actually go to our YouTube channel. I guess we record it live. It'll be recorded and dated by the time it gets up there. But that's at youtube.com/DoubleLine Capital. So Todd, welcome to the show. I've known you for many years, covering us on manager research and things back at your old firm as well. So why don't you give our listeners a little brief history in the life of Todd Rosenbluth?
Sure. So I was originally a financial advisor at Morgan Stanley and realized that I liked doing the research and wasn't as good at the relationship building as a 22-year-old. And I moved into the research world, primarily focused initially on mutual funds, which is how I know of DoubleLine. I know of you, Jeff, and the broader team. I was at Value Line. I then went to S&P. I then covered individual stocks from a fundamental perspective, and then moved back in to focusing on both mutual funds and ETFs. I enjoyed doing that so much that I actually asked my company, S&P, to stop letting me cover stocks and let me focus only on mutual funds and ETFs. I saw a niche to be able to dive deeper and do the due diligence that you talked about. I spent about 20 years in total at both either S&P or the company that got spun out of S&P called CFRA Research, where I was doing independent research. The last 10 years of that 20 was focused solely on mutual funds and ETFs. ETFs became a greater part of my focus, and 6 months ago, I moved over to a company that is probably known to many of the listeners, ETF Trends. And then 3 months ago, we rebranded ourselves from ETF Trends to VettaFi. And can tell you more about VettaFi as well, but want to just not make this be a monologue.
Yeah, no, I see you're wearing a pin on your lapel. Is that the VettaFi logo?
It is. Look at that.
Yeah.
You're encouraging folks to go to the YouTube channel right there and see what I'm wearing. Yeah. So the V is for VettaFi. And what we did is we brought a few different businesses together under one roof. So there used to be an index capability under Alarian and S Global Networks. There was ETF Trends, which is the company that I joined, and then ETF Database. We brought those brands under VettaFi. And we are attempting to be a one-stop resource for a variety of financial needs. So we've got indexing, about $14 billion of assets are benchmarked to indexes behind VettaFi. Thought leadership is the side of the business that I'm on. I'm writing research and commentary on our ETF Trends website. I'm also being a part of the webcasting team that does some digital distribution and commentary. And then we've got a lot of great data and analytics about how advisors, how investors are thinking about ETFs in particular, where their focus has been, and then I'm using that to write commentary and research about it. So it goes in a nice flywheel to sit in the middle between investors and asset managers. So some listeners, I guess, on both sides of that, hopefully to this podcast.
What's the genesis of the name? Oops, sorry. Cut you off.
I was going to say, I hope there's some people listening to this since we took your time, Todd. But yeah, Sam, go ahead. Yeah,
I just wanted to see what the genesis of the name. It's a pretty unique name there.
Yeah, so there's some iterations of it that's tied to Sanskrit in that Veda has to be able to do an understanding and to vet something, to be able to do focus on due diligence and research is part of where that name comes from, the Phi in terms of finance. So our goal is to just sit and be where knowledge is power, and we want to be able to provide our end clients, which are both advisors and asset managers, help them achieve their respective goals. So I didn't know any Sanskrit before. I probably still don't necessarily know it, but it's just a sign of we've gone deep into the resources. And what hopefully the listeners will know if they look at the spelling of it, it's VettaFi. This ETF is right in the middle of that. We hope to have ETFs be right in the middle of a lot of what we're doing. And I guess I'll do this before I miss the opportunity to belatedly welcome DoubleLine into the ETF community. You guys launched ETFs earlier this year. I know we can't go too in the weeds on that, but I want to say congrats.
Yeah, well, thanks for that, Todd. We really appreciate it. And as Sam likes to say, he's a big G.I. Joe fan, that knowing's half the battle, right? So, it's good that you know at least one word and the definition in Sanskrit, right? So, thanks for that. And, we don't want to run afoul of compliance and everything. So let's steer away from our ETFs today. And why don't you tell us a little bit about the industry? What are you seeing in the ETF world? I know, there's been every year, it seems there's more and more launches. It's been a challenging market. What are you seeing, out there in the space today in terms of launches? What are you seeing resonating with folks? And, what are your interests in coverage today?
Yeah, so let me start at the 10,000 foot or so level, and then we can make my way down it. For perspective, the ETF market is around $7 trillion, or US market is around $7 trillion. That was boosted by over $900 billion of net inflows in 2021. We are on pace to probably have about $600 billion of money go into ETFs this year. We're at 350 billion or so, give or take, by the time we're recording this, as mentioned on August 11th. So it's easy to go, well, 900 billion now to 600 billion, that must be a disappointing year. That would be the second strongest year ever. And as you and certainly the listeners know, we're in a bear market for most US equities.
No, Todd. The NASDAQ is now 20% off the lows. We're in a bull market. It may be 40% off the high, for that decline. But that old quirky thing, right? Yes.
That is true. I guess I was using the S&P 500 as my reference point, and I don't believe we've come back to that.
No, fair enough. And I believe in the Ritholtz. If you've listened to Barry Ritholtz, right? You gotta cross the previous high and go 20% before you can declare it a new bull market.
Yeah. Well, it's certainly what it certainly has been is a tough year to be investing in equities if you were starting in the beginning of the year, and if you were patient and passive, and perhaps we can talk about active and passive as part of this. It was as again, you certainly know better than I do as managers of fixed income strategies. It was the worst first half for the Bloomberg Barclays Ag. And so that's not a backdrop that would necessarily have people running to put money in. And what's happening is people are putting money into ETFs. And that's what excites me is it's not easy to bring in money as an asset manager in a perpetual bull market, but it's certainly easier to get people to do that. And so investors continuing to turn to ETFs as a vehicle of choice is particularly exciting in this environment. And so I'm excited about that and what we're seeing. And yeah, we're seeing, I guess before we get to the products that we're seeing, that's interesting, where we're seeing the money is also has been interesting. So it's been a challenging year, again, with the ag relatively low, people and yields, bond yields having been climbing. We've seen investors look for alternative forms of income. Dividend ETFs are going to have a record year in terms of net inflows. We've seen other equity strategies, covered call oriented strategies that have been very popular with investors. We've been seeing on our website through VettaFi that we're seeing real estate gain traction as investors are looking towards defensive areas of the equity marketplace. That's been popping up. And I mentioned one of the things that we do is we do webcasts. So we're talking to advisors. Well, actually, we're asking them questions through on a digital format on a weekly basis and getting answers. And we're continuing to see that they're looking for something else other than core fixed income. They're looking for an enhancement to that through fixed income, through other asset classes. We're also seeing them look towards various equity strategies that I touched on earlier. And then I'll pause in a second. But what's also exciting is that the month of July was was a very strong month for fixed income ETFs. And, they're roughly 20% of the overall ETF marketplace. And there was, I think, double the inflows for fixed income ETFs in the month of July. And we saw it towards equities. The Fed has obviously been very active this summer, and that investors are turning towards fixed income ETFs. They're leaning in to either take risk on or risk off. Has been exciting because this is certainly a year that you could say, all right, I want to move out of fixed income. It's too challenging for me. That's not what's happening. We're seeing investors rally to the fixed income ETFs in particular in July and again thus far in August.
And you brought up one point there, about the flows and everything. And I've been asked by a couple of market punditry that, ultimately, why do you see the flows in fixed income ETFs? And, is it a transition, because you're seeing the outflows in the mutual fund side and they're going you're seeing flows into the ETF wrappers. Is it something different about the space? Or, kind of my contention was that it could be some of this tax loss harvesting that you're seeing in the marketplace. That's hard to ever pin your finger or put your finger on it and really understand that. But do you think that that's part of potentially some of the conversion where it's saying, okay, I have this ability to sell some of my mutual funds, I can convert to this wrapper? Or do you think it's just something different going on? So I'm just curious about that.
I think it's a combination of things. So yes, it's certainly tax loss harvesting is playing a role. If you were down 9%, give or take, in the first half, as many of the core bond mutual funds were, that's not a great environment to hold on to. And so if you're going to rotate in and continue to have a heavy ballast towards fixed income within your portfolio as an advisor, you could rotate away from some of that and put in perhaps an index-based alternative. So you're not replicating exactly what you're doing if you were choosing an active mutual fund beforehand, going with an index-based passive, to just wait out and be able to see what's going on. But then we're also seeing, what's interesting to me is money is going in to both the short end, ultra short bond ETFs have been relatively popular as people waited out, and then people are taking on additional risk. We saw strong interest in both investment grade corporate bonds as well as high yield bond ETFs. Again, during the month of July, I recently wrote a piece on ETF Trends, looking at the strong inflows to the variety of high yield bond ETFs, erasing some of the net outflows that we saw through the first half of the year. That July was a very strong period. Investors looking to take on some risk, but also balancing that out by managing their duration in the rising rate environment. So taking on credit risk, but reducing that duration risk, which again, I've been on the other side of this conversation I haven't been with Sam, but with you, Jeff, asking you, is that what you're doing? So my temptation is to do just that. And I won't do that. I won't flip the script.
Yeah.
But I imagine that's what active management is doing as well, is trying to find the opportunities within fixed income instead of sticking with a core.
Yeah, no, I think also, some people have asked me that, is it neurotic when you look at the flows? You see back end, you see, front end of the treasury markets, right? As you pointed out, and you see high yield, being really one of the beloved childs here, right? And so I said, it actually makes some sense. If you're going to buy high yield corporates at this point, you probably want some risk offset, right? And so that's that, recession fears, right, that drive people to like the long bond ETFs, right, or the ones that are on the back end of the yield curve. And I said, that makes some sense. The front end, it's pretty attractive these days, right? The problem with the front end a little bit is most of us think it's probably going to go up a little bit more, just given that the Fed's probably going to be a little more aggressive. And I think I said in my last podcast, I would fade the Fed forward curve at this point. I think that they're going to be much more aggressive than the market's price. I think 3.5 terminal rate is just too low. And you're hearing it from Fed governors as well, especially with economic data picking up. That said, back to the high yield argument. I mean, what a run we've seen in like 6 weeks, right? I mean, and it's been driven by flows. And so where money hasn't been showing up in a lot of pockets of the market, it has been really showing up in corporate bonds, IG as well. But we all know that the investment grade or IG market definitely has that duration component, right? So I think there's a little bit of fear. So look, I mean, if you like corporate America, you believe that the economy is strong, that barbell type of approach of buying a longer duration treasury, mixing it with a high yield, putting in the right dollar amount, I think you can get a better yield profile and a better risk off profile than necessarily say the investor grade corporate market. But again, it's getting a little complex in there of trying to, you got a key rate duration and things like that mismatch. But I do think that there is something to be said about that. But I'll tell you internally, we've been a little bit of a seller of high yield with this, because when I think about where we are in the macro economy, I think there's still some noise coming. I don't believe we're in a recession. But what I do think about is that, if I think about the slowdown in growth, high yield spreads no longer reflect that slowdown, right? We were pricing close to a recession when spreads got to almost 600. Maybe it's on a dire part of the recession. It's definitely a significant slowdown. But at like, a 420 spread, right, that we're seeing today, doesn't seem like it's enough to get us through a slowdown. So we've been fading that a little bit just because, again, you have a little bit of other areas that have been slower to recover there. So what are you seeing in terms of that flow data? Do you think that is chasing performance, or do you think that that's really a matter of advisors kind of being forward looking on things and saying, look, I think there's ways of using these pieces and these sectors of the market to put together an asset allocation?
Yeah, I think the latter. I think that, there's certainly going to be always some performance chasing that takes place, but I think advisors are increasingly using the ETFs to rebuild the portfolio that they want to have for clients. And more they're gaining comfort with the various tools they have in the fixed income marketplace, so that they can be able to not just have just core bond exposure, they can raise the risk profile with high yield. What was interesting in sticking with the high yield is that we saw people actually rotating out of, or money rotating out of, some of the short-term high yield. So both iShares and State Street have, have the two largest of the high yield ETFs. They also offer short-term versions of those products. So the duration, short-term being, the duration goes from 4 years to 2 years. So not a lot, but still enough that you can be able to manage it. And we saw in July that money moved away from that shorter term and into the more traditional high yield. But I recently did a podcast where we gave advisors the option of where do they see the most attractive opportunities within the fixed income marketplace. And we essentially took 8 slices of the fixed income market. And we did see that barbell approach. So we saw high yield being number 1, and then slightly behind it at number 2 was the ultra short bond ETFs, as opposed to core, as opposed to munis, as opposed to long-term treasuries, as opposed to, I think we gave them the option of mortgage bonds, although that's you guys will know that better than I will, but that's a slice that is harder for an advisor on their own to dial up and dial down, but we wanted to give them the tool that was there. So people being able to use more tools in their toolbox, we're seeing that with advisors, we're seeing institutions increasingly move into using fixed income ETFs, them being asset managers, them being insurance companies, hedge funds, and of course, the more buyers and users of fixed income ETFs, the better that is from a liquidity perspective. That's one of the benefits of the ETF structure, is there's somebody that needs to be on the other end of that trade in order for you to sell. The more people that show up to the ETF marketplace, the better.
Yeah. Hey, Todd, one of the things I wanted to ask you is, it just seems like, just from my observations, that ETFs, in terms of new strategies that come out, seem to move at a faster pace than mutual fund managers when they come out. So over the past, let's say, even just looking at it since the pandemic, there's been a number of FOMO type investment strategies that have come out as it seems like managers are trying to capitalize on that theme of the day or the month. The crypto ETFs were a big topic back in 2021, and then all of a sudden you don't really hear much about them in 2022. Same thing with the meme stocks, that came out, just ETFs focusing on these very specialized niches. What are some of the things that I guess prospective investors should be aware of when they're thinking about these ETFs, instead of just seeing it as money grab perhaps by the managers? Sometimes they do have good foundations underneath them from an investment theme, but just what are some of the things that they can think about there? One of the key things is, sometimes the name of the ETF, while it sounds like maybe it focuses on green energy or, vegan ETF, type things, sometimes the underlying securities don't necessarily match that marketed name as well. So, what are some of the caveats that people should be thinking about when they consider these?
Well, I love that. For those that are on YouTube can see me leaning forward and getting ready to respond to that. So you had a couple of things in there, Sam, I want to make sure I touch on. Yes, in the ETF marketplace, things tend to move faster than they do in the mutual fund world, and even faster than beforehand. So there's regulations that came about. I won't get too far in the weeds, but it made it easier to launch an ETF. It made it less costly to launch an ETF. And so we're seeing both large asset managers as well as ETFs, people who run money as advisors from a strategy, turning some of their products into an ETF and being able to do so relatively quickly. Some are broadly based in their strategies, and some are very narrow and niche oriented because it's a concept that they believe in, or they think there's an opportunity, or they see this as just that, something to be able to do. So we're big believers. I'm a big believer that broad asset allocation still matters, and you want to be diversified. So it again makes me happy. I keep dropping these webcasts, but I do one or two webcasts each week. And I just published a piece today that looked at thematic ETF investing, and it made me so happy. We did a webcast with ARK. Again, I'm not name dropping products, but we did one with ARK, and that's what they do, is thematic investing. So it wasn't surprising to me that people on that webcast were interested in thematic investing, but it made me happy to see that they were using, the majority had between 1% and 10% of their asset allocation in thematic investing, that they weren't crowding into these products, because of course the higher reward also comes with that higher risk. So that made me feel good that the advisor base was being more prudent in what they're doing. So that would be, I guess, my lesson one, is the narrower the strategy, it has to be built around something that's core, whether that's active or passive in the ETF space, or a combination of that, because the narrower the slice, the more you can get hurt. But the ETF marketplace is relatively crowded, and certainly in anything non-core. So whether that's a sector, a style, a thematic approach to it, the name of the ETF, let alone the ticker of the ETF, only tells you so much about what you're going to get inside the portfolio. There's half a dozen clean energy ETFs that have the phrase clean energy in the name, and that's increasingly popular given that what's happening with legislation in the United States that might result in more spending to support and provide clean energy. The devil is in the details, and you really need to understand what is inside the portfolio. The stocks, in the case of this stock portfolio, are going to drive the future returns. You need to know if you're buying utilities that are cleaner than the alternative, whether you're buying technology and specifically semiconductor companies and electric equipment companies that are helping to support the solar aspect, whether they're industrial companies that are manufacturing some of this. And so it's really important for an investor and advisor to take advantage of the transparency that you can find through most ETFs, to be able to look and see what it owns at an individual security level, but also rolled up at a sector or an industry level, and do your homework. Make sure that you understand what you're getting, because there's magnitudes of performance differences behind ETFs that sound like they're the same, they're delivering the same exposure, and then you go, wait, what happened here? So there's a difference between the S&P 500 and the Russell 1000. Obviously 500 stocks, but not exactly, because they're both market cap weighted. But as you slice the indexing world or the equity world, that becomes even more noticeable. Same thing within fixed income. If you were only in high yield, but the product was only focused on double B versus something that had double B or single B and triple C, you really need to understand what you're getting. Tickers are great. That doesn't mean they're the right investment for anybody.
Yeah, well, you point that out too. Like, it's not just, you can have the same universe of things, especially when you're narrowly focused. The weighting scheme is going to matter massively, right? Because you're going to get a lot of more idiosyncratic risks. But talk to me a little bit about that, the tickers, because I've noticed that there's a lot more people being clever and, trying to get tickers in the ETF world that are either catchy, thematic, we probably did it ourselves, but when I think about the mutual fund world, right, they're kind of boring, right? There's not a lot of people out there with these, tickers that somewhat kind of connote what you're doing. And so do you think that helps some of this marketability, or am I just overthinking it?
So no, you're not at all overthinking it. So it depends upon who the audience is. So increasingly we're seeing adoption of ETFs by retail investors. Tickers matter a lot more to a retail audience. And if you are going to be thematic in nature, you want to have people at first glance understand it, especially if you're a relatively new entrant or a relatively small entrant into the ETF marketplace. A catchy ticker, again, I'm going to try to not name tickers here, not yours.
I baited you into that, and then say don't mention it.
Yeah. But if you think of cybersecurity,
you go ahead and say it. It's okay. We're not promoting them. Just go ahead and say it. It's on your mind.
So if you think of cybersecurity, I'll use cybersecurity as a good example of it. And I'm not at all recommending any of these products. But the first product that came to market, the ticker was HACK, HECK. That you can connect that very directly with cybersecurity. Another product that came to market was Bug, BUG. Again, you can connect that to it. CIBR is a third one, and then IHAC is a fourth one. If an asset manager came to the marketplace from a large provider whose name I won't name that doesn't have it, and they went with their nomenclature where they put their first letter in front of it, it probably would need to have HAK at the end of it or something that made it obvious that they were connected to it. In the mutual fund world, people were buying and still are buying funds based on the fund family and the management that's behind it. And they often know who that manager is, who's running the strategy. In the ETF space specifically, since many of those are index-based, you want to paint a picture for an investor. You want someone to think, I want exposure to this. What's the appropriate ticker that's there? So some of the products don't need that. The first mover advantage in high yield, we have some of those. Since I remember, HYG is high yield grade, I guess, is the G that would go with it.
I thought it was high yield guy.
And then J and K being junk. Again, you can see the image that goes with it. So it works. But a good ticker only gets you should only get you so far, because once people will get their statement and see that the thing went down, there's no loyalty to a catchy ticker.
Yeah, I mean, I guess part of that too. I mean, when you're trying to entice people via the name, it just seems like fancy, marketing. Actually, no, I'm gonna stop what I was gonna say there, but enticing via the name. But a big part of it, and with ETF strategies, the evolution, they've gotten a lot more sophisticated and a lot more complex, going away from just the basic broad-based indices of multiple sectors or even asset classes within them. But as they've gotten more sophisticated and complex, they've become a little bit more unidirectional too, right? Where investors that use it, perhaps even for a long-term or a short-term trade, can get caught offsides pretty quickly and pretty significantly. I'm talking about some of these short or inverse performance ETFs with that inherently a lot of times have that negative carry where they're actually losing, a certain percentage a month. And also these, especially these leveraged 1 or 2 or 3 plus times types of ETFs. So, oftentimes what I hear from the marketers of certain ETFs is that it's meant for the sophisticated investor, but there's no real checks and balances around that so-called sophisticated investor. So has that investor base, particularly the do-it-yourself type of investors, have they evolved enough to match kind of this progression in these ETFs? I was kind of rambling there as I
no. So I hope they have. So what we've seen and July and early August has certainly been eye-opening. It's supposed to be a slow period of time. Summer months that we've seen continued money moving into it, as well as evolution. So what we've had in the last few weeks are single stock ETFs that are either inverse, meaning that your benefit when the value of the security, the stock inside, like Tesla, for example, goes down in value, you'd be essentially shorting it, but through the ETF structure and having that rolled over, or leveraged versions of it. So you take a 1.5 times leveraged version of Tesla or Apple, to name a couple of the companies that are there. Do I think that the average investor understands what is involved in shorting and how much you can lose in perpetuity if you hold on to that? Or do they understand that when you have something that's levered, the risk is magnified? The reward is too, but the risk is magnified, and that matters more on the downside. It concerns me because there's little to nothing stopping an investor from buying it, especially on a retail platform. So some advisory programs aren't allowing leverage in inverse products. They probably won't allow these products. But you can go on to Schwab or TD Ameritrade or Merrill Edge or any of these platforms, I believe, and put in that trade, and now you're on your own to be able to do that. We now have nowhere near to the same risk, but we now have single treasury-oriented ETFs that just came to market recently. I don't think the risk is, again, you're buying a treasury and it's not leveraged, but you're not getting the benefits of diversification across the maturity spectrum, and is that worth it? So we've seen much more sophistication in the ETF marketplace that is both good in that it gives investors more tools to work with. That's bad if they don't understand what those tools are. I want you guys to respond to it as well, but the flip side of that is we've now seen products that are not in the same realm, but a company innovator launched what are known as defined outcome, or my words as well as theirs, buffered ETFs. So you could own Tesla with downside protection. So is that a better investor experience than just owning Tesla? Yes, because you're protected on the downside, at least from a risk reduction standpoint, but you're paying that price to be able to do that. And so is that worth it for you to be able to have? But innovation is good as long as investors understand what they are and not getting. I mean, I'd love to hear, again, I don't want to take over, but I'd love to hear your take on, you guys are fixed income specialists, your take on what we're seeing.
Well, I'll jump on that grenade, but I think, that I'll contradict you real quick, Todd, on one thing. The benefit of the inverse, or those super levered inverses, I'll call it the 2 or 3x inverse, is that you can't lose money you put up because you just go to zero, where the structure, because it rebalances and things, right? So effectively the end client can actually, can't lose money they put up. So I'd say that's a benefit. I'm just trying to play devil's advocate on that.
Yeah.
However, the 3x levered ETF and the inverse on the same underlying 3x ETF, the best trade you can ever do, and this is mathematics and beyond the scope of this, you short them both. And inherently, you want to short them both because they're inherently short volatility too. Like volatility kills returns, and so when you have a volatile market, those both go to zero. So that's why you short them. But anyway, that being aside, I don't have criticism for these single stock things that, especially leverage, because some people can't get access to it. Do they understand it? I don't know. And it's like, how often does the leverage rebalance? It's the rebalancing that inherently you're kind of short volatility. So or volatility kills you. You're on the other side of that trade. So you're short vol. But when I think about like the treasury stuff, I just don't understand it. Like why anybody who has that Schwab account can enter a QSIP and go buy the 10-year treasury. So again, not to criticize the firm that put those out there, I'm just not sure what you would do there. And I was told, well, you can do a 2's10 steepener or a 2's10 flattener, and you can bet on the yield curve. And I'm like, no bond people do that. They use futures, right? So
Right.
Again, because it's cheap, it's easy, net margins, like there's a lot of benefits there. So I think a lot of these things, are they the financial weapons of mass destruction, as people call them? No, but they're probably not meant for common people. And so I find it pretty amazing that if me as a sophisticated investor who's been investing, professionally for 20 years, if I want to open an options account, I got to give them a blood sample. I got to demonstrate all this, knowledge and everything. But I can go buy this levered fund without any qualms about it, right? So that's where I think that some of it is dangerous, But the buffered stuff, I kind of agree that, look, it sounds good, but people don't understand. You're buying puts, you pay a premium for that. You're buying insurance along the way, so there is some cost. But you're going to say something.
I was just going to say that the good part of this is that even though this is that little money is going into it, some activity happens in these leverage products, in these new ones, and they're fun. Well, they're fun and interesting to talk about it. But the core S&P 500 based equity ETFs continue to pile in money. That's where most of the money is going into. So that's it. At the risk of saying what I wrote on Twitter as if that was relevant to, for this forum, but it's a boring headline that more money went into the S&P 500 index-based ETF from XYZ ETF today. But that's what happened. That's where most of the money is still going. That's the core. And so some people are playing around. Hopefully they're playing around in a smart way with these unique products, but they're rounding it out. And that again makes me both happy about it, but also I know, headline writers have to write headlines for a reason.
Yeah, but although today the headline writers did pick up the boring part and said there's a new bond king in town as one of the providers overtook the other one, right? So, and they were both passive products, by the way, with 80 plus billion in each of them. And so, I think that it's the market is king, not necessarily the management there. So let's shift gears real quick, Todd, because you're not just an ETF person, you're not just a fund person, you're a markets person too. So, talk to me a little bit. Sam wants to know, we've got a big ship to steer here. He wants to know, what do you like in the fixed income market?
So I think that high yield is still a good place to be able to get it, from an income perspective. I find that you can get, again, I'm looking at this from an ETF perspective, not an individual security perspective. You get the benefits of diversification throughout that credit quality spectrum. I'm of the three of us, I'm least qualified to be able to answer, are we headed into a recession? But I don't think we're going to be headed into a recession. And so I'd be willing to take on credit risk and think that that's worthwhile. And you can get some relatively low cost ETFs to be able to get exposure to that, to that world. I know more the equity side than I know the fixed income side, but yeah, high yield is where I'm happy to see that we're seeing money continue to come back into, because I think that's going to be rewarded.
So on that note, I got two questions, two-parter, I guess. One, what are you thinking about equities then? And then second, I enjoy reading your research and your commentary. So, maybe if you're able to, if you can give us a sneak peek on what you've been working on for the next iterations.
Yeah, so we're probably, I don't know how fast this is going to get turned around. I tend to write the week ahead, often for the week ahead. for what's going on. So I recently, I guess I'll talk through what I recently wrote about. I mentioned we talked about thematic investing and the trend that's been going towards that. And I looked through the various clean energy ETFs. That is an article on ETF Trends related to that. The range to your question that you asked earlier, Sam, I referenced 4 different ETFs. 2 of them are up for the year and 2 of them are down for the year. And the ones that are up, there's a good 500 basis point difference between them. We consider those all to be clean energy ETFs. So getting inside and knowing what that is, we've been seeing this. We talked about equity and we talked about fixed income. I'll come back to equity in a second. But commodity ETFs have been very popular. They're roughly a low single-digit percentage of the ETF marketplace, and they've been punching above their weight this year. Inflation fears play a role in that. The war in Ukraine and the shortages for agricultural products plays a role in that. But I'll have a piece that will be out by the time the audience probably is listening to this. It'll come out on Monday. That's just looking about where we're seeing a shift. So we saw a strong interest in natural gas related commodity ETFs in the month of July and less interest in crude oil. Nat gas did very well in the month of July from a performance standpoint and snapped back. We saw a strong interest in corn related products. Yes, you can get exposure to corn and corn futures through a product, but less interest in wheat. I'm not knowledgeable enough about the agricultural commodities marketplace, and so I lumped those together. So I thought they would be gravitating in one direction, and they were going in 2 opposite directions in terms of the traffic that's there. I will probably be writing more about just emerging markets. That's another area that seems to be piquing interest. Emerging market equities, that is, with our audience. It's bounced back. Obviously, it very tough first half of the year, but it's starting to bounce back. And we're seeing money move back in, and we're seeing investors and advisors differentiate. You've got the broad market products, but then you've got some more thematic ones. You've got some country-specific ones. So we'll probably dive into that one more time. But from a U.S. equity perspective, which is I think where you initially were asking me the question related to it, I think quality orientation. So slight defensive, but quality orientation, and I think we're seeing that again. I again want to put you guys on the other end of this, but I think we're seeing the defensive sectors that still hold up from a momentum standpoint for the most part. A bit of rotation that seems to be happening, but that's encouraging to me that we're not seeing people chasing, and we're in, as you mentioned, a bull market for the NASDAQ. We're back into it, but we aren't seeing necessarily a flock towards technology. It isn't just driving the market higher. We're seeing some broad representation. So there's ETFs that offer a quality tilt to their portfolio that I think are gaining traction.
Yeah, I'm always amazed when people trade the natural gas stuff because, that's been historically known as like the widowmaker. And for those who don't know, read the story of Brian Hunter out there from Amaranth on that widowmaker trade out there. But the carry is so crazy in that stuff. And you have this weird carry in it, you have this weird vol in it. And a lot of people just don't understand, what it looks like. And, it's like the people that complained about the oil ETFs and said, well, it doesn't track oil. Well, if you read it, it tracks futures, which, you have this complexity of the term structure. I guess one last thing. What do you think about some of these thematic ETFs that are like the anti-trade? So I read today that and again, not to criticize this, but like Peter Thiel filed for, this one that's about drilling. It's like he calls it the anti-ESG, and that's the blatant thing. And or the Vice stuff. What do you think about those type of things? Are those just trying to be catchy too? I mean, because we know historically tobacco has been a great place to invest, right? Because of, again, people avoiding it. So what do you think about, potentially some of these, and I'm not trying to call out any of those specific themes, but as investors gravitate towards these ideas that someone's trying to kind of do the anti side of it?
So first of all, I guess I like that the ETF structure is where that's happening. That you wouldn't see that in any other broader asset class. Obviously people short stocks, and people have shorted high profile stocks based on the CEO. But we have, again, not named, we have a short ETF tied to ARK. I won't name the ticker, although you could easily connect the dots on it. That's novel. You're betting against that overall, the manager.
It's kind of weird though, because that's like an actively managed ETF. So that's the thing that I find.
Yeah.
It's one thing to have an inverse to an index, but it's like you're almost saying an inverse to the manager, right?
Yeah.
That's a whole different type of beast to me. I don't know. What do you think?
I think that ARK is high profile and people have a favorable or unfavorable view about it. They are not the New York Yankees, but I'm here in New York. I'm a Met fan. You have an opinion on, around the country, you have an opinion about the Yankees. You're either rooting for them or you're rooting that they don't make it into the playoffs or into the World Series. I think that
I'm just rooting for Judge to stop doing so well, so he leaves the Yankees and joins my Giants. That's the goal, because like we're the number 2 favorite to get him. So
let's hold up on the that kind of talk, as you guys are eating into some of my Sherman Says prompts here.
Oh my goodness. Okay, well I won't get into that. But I do think ESG gets more attention than it gets assets, but it is gathering assets, but it's still a very small part of the ETF marketplace. So, and it's not the money that's gone into ESG ETFs, not in ESG investing, but ESG ETFs isn't moving the needle. ETF money going into ETFs isn't causing stocks to go up or down in value. That's the tail wagging the dog that somehow we made it 40 minutes in and I didn't use that analogy up until now. So yay me for that one. So an anti-ESG version of it, okay, maybe there'll be it might perform very well. I don't know that there's going to be enough interest. We've seen these political affiliated related ETFs come to marketplace to try to capture investor interest, and they just don't get there. And
it's funny. I looked one up right before I came on, and it was like 16 million. I remember it was the talk of the town, but I won't mention it. But yeah, right.
Yeah. So, and part of, I think there might be demand if there's performance. In the case of, you mentioned performance chasing, that might happen. And more power to them. I think Strive is the company that launched its first product. You mentioned tied to drill. Let's see if it works. I mean, energy has certainly done well. They're a little late to launch an energy ETF in 2022, but energy is likely to continue to move higher. So we'll see.
Yeah. Okay. Fair enough. I don't want to put you on the spot. I know you got to cover these names and stuff too. So I don't want to get too deep into it. But, I guess speaking of letting the cat out of the bag, Sam let the cat out of the bag that, his favorite part of the show is the Sherman Says. And he's just so dying to do it. He even talked about it already. So, Sam, why don't you transition this over to Sherman Says?
All right. And then after that, let's see here. With that, Todd, Sherman Says is where I will offer a series of alternating prompts between you and Sherman, to which I hope to get a concise, top-of-mind response. Professor Schiller has referred to this as a verbal Rorschach, which he abhors. Participating in. So let's see how you weather or stand this test here. So I'm going to give the example out there of Sherman for U.S. housing market.
Fading strengths, but strong.
All right, over to you, Todd, with fintech.
It's evolutionary, but still very early days.
Sherman with credit rally.
It's not uniform. And what I mean by that is the high yield is really taking off. The IG is catching some of it, but it's got the interest rate component. But other pockets of the market really haven't seen it. We have seen EMD rally a fair amount as of late, especially in the below investment grade, but there's been a big lag in other parts of the market. So I think you need to be long the credit rally. I'm with Todd. I just have a few other preferences over high yield at this point in time, given the rally it's seen.
All right, back to you, Todd, with single stock ETFs.
Oh, boy, risky. You better know what you're doing. I would equate it to I would be very dangerous with a set of power tools in my hands, but with the handyman in my building, certainly know what he's doing.
Yeah, I shun all power tools, and Sam welcomes chainsaws. So like that's why you need someone like Sam in your life if you need to cut down a tree. So
hopefully that's all I'm cutting there. So single bond ETF, Sherman.
they're okay for now. Like just don't do it on corporate bonds because you get a single bond, like, pick XYZ name, and all of a sudden you can end up owning the whole issue. And how do you source it and things like that? And by the way, the CDS market's going to face rip you on the institutional side. So I don't know, but it's going to come. So we'll see. We'll see if I'm right or wrong about that.
20-year single bond treasury ETF there. Let's see here. Over back to you, Todd, with tax on corporate stock buybacks.
I think that it's not going to, I think it's going to raise revenue and not impact the buyback activity. Companies are going to be creative in making sure they limit their taxes and still are able to buy back shares. So I don't think it impacts the market much at all.
So Todd, guess what? You just now signed up for an audit with all those new IRS agents coming. So be forewarned.
Sorry, Todd. Sorry, my bad. Over you,
you can have Sam be your accountant on that one since he sets you up for that.
Yeah, I don't give tax advice though, so make sure I say that, right? So whose is it now? I think it's Sherman's consumer balance sheet.
It's healthy, and I see all these people, what people call the denominator problem, that they say, oh my gosh, credit card balances are all-time high, but they forget about the strength of the other parts of the assets of the portfolio. And so if you own real estate, you own some financial assets, they're in better position. So again, it's a bigger economy, there's some inflation, and so owning some debt isn't necessarily a bad thing. So I think much is made about it, that the balances are high, but when you look at it as a percentage of overall disposable income or net worth, it's not concerning. Obviously, that can change in a big downturn, but at this stage, not concerning.
All right, to you, Todd, with Fed balance sheet.
Yeah, I don't know that I'm qualified to give much of an answer on this. I think they're doing a good job of winding down what they have on a monthly basis. I don't track it enough, but it feels like they've got a good handle on it. But I'm a big believer in trust the Fed, and I don't know enough not to.
Well, because the saying is don't fight the Fed, so it's a very similar one, right?
Yeah.
And don't fight the IRS. That's my corollary. Don't fight the IRS, Todd.
Final round here, gentlemen, with for Sherman, Hunter Pence.
I'm a big Hunter Pence fan. He's a quirky dude. I own a Hunter Pence jersey, Sam. You don't know that, but I do have one, and it's in the black Giants jersey, and it has a big, solid Metallica patch on it. So even though he's gone, I rock it because of Metallica on there as well. And I just saw him announcing a game with Bob Costas a couple of days ago when I was watching the Padres-Giants game, the only game they won. That the Giants won of that 3-game series. And I'm trying to figure out how the heck he got a gig actually announcing with Bob Costas. And this was the day of the Vin Scully tribute, and they were talking about how they'd all driven down and everything. So Hunter Pence just seems like a cool cat. Love to hang out with him. Hunter, if you ever listen to the podcast, hit us up. Sam and I'd love to have a drink with you.
Sounds good.
Yeah, pandering, that's what I do best. Come on.
All right, Todd, you're going to wrap this one up with, let's see. So you talked about being a Mets fan. How about LA Dodgers for the National League Championship Series?
Oh, well, the Dodgers, if they can stay healthy with pitching, I mean, the lineup is stacked, but they keep pulling out pitchers out of the bullpen that I didn't even know were still in the league or I thought were washed up. They're like the Yankees in that when you put somebody on the roster, they all of a sudden they play so much better. But yeah, if I'm picking my Mets. Yeah, because it's been a long time. And I remember 1988. I was around when the Dodgers knocked the Mets out. I was 13 and it was crushing. So yeah, payback.
And Todd, I remember the Mets knocking the Giants out in NLDSs as well. So that was probably in the 2000s. So
Yeah.
Look, that Dodger team is just crazy. 700 this time of year, 77-33. I saw they were. The Padres are playing well in the NL West and like 15 games back.
Yeah.
But
No,
your Mets
this
is
is
good.
baseball's fun. Again, I'm as a Met fan, baseball's fun. The Giants are still in it, and thanks for Darren Ruff.
Yeah, you're welcome. And JD looks okay so far. So plus we got 4 guys. We'll see. We need some arms too. But what I'm worried about the Dodgers is Walker Buehler coming back. So that guy's just a giant killer, and so hopefully he's not a Met killer too. So if they're playing, Todd, I'm on your team. So if you're playing the Dodgers, I'm always the anybody but Dodgers fan. So
yeah, I am that way with the Phillies, even though they're not as good as they were in prior years. But yeah, anybody but the Phillies.
Yeah. All right. Well, Todd, thanks again for taking the time. Thanks for playing along with us there. But most importantly, can you tell our listeners where they can get access to your research, where they can follow you, so they can get all the insights we get from you as well?
Well, that's awesome. So our research, you can find what I write at etftrends.com or www.etftrends.com. The company is VettaFi. You can go to vettafi.com, see that Sanskrit background and information. And I'm on social media at Todd Rosenbluth, and love to engage with folks.
Okay. Well, Todd, thanks for taking the time. It's a pleasure to host you here. Like I said, I've known you for a while. I appreciate all the insights you provide too. And, it's great just to shoot some baseball jargon around with you as well. So
awesome. Well, thanks a lot, Jeff and Sam. My pleasure.
Okay. Thanks again. And for those of you that weren't watching this on the YouTube, you can find this on Apple iTunes. You can find it on SoundCloud, Spotify, Google Play, Stitcher, and all the other things that Sam streams his podcast with. So thanks again, Todd, for taking the time with us today, and tune in for the next episode coming soon.